The money in your bank account isn't sitting in a vault the way you think it is. How sure are you that it's really there? This isn't a fairy tale, and it isn't a lie. If everyone went to their bank tomorrow and tried to withdraw their money at the same time, the system would come to a halt very quickly. Because that money isn't sitting in a vault the way we imagine, this isn't a flaw. It's not a malfunction. It's a structure designed to work this way from the very beginning of the financial system. Today we call this fractional reserve banking. It sounds technical, but the idea behind it is actually quite simple, and this idea helps us understand why debt, inflation, and what we call wealth so often remain just a feeling rather than something solid. To understand this, let's go back a little. To a time before digital screens, before money became nothing more than numbers inside an app. In medieval Europe, money was gold and silver. If you were wealthy, you literally held it in your hands. But carrying gold was risky. There was theft. Travel was dangerous. So people began leaving their valuables with goldsmiths, men who had secure vaults. In return, they received a piece of paper, a receipt saying you can come back and collect your gold whenever you want. Over time, people realized something. Using this piece of paper for trade was far easier than carrying the gold itself. After all, the paper represented the gold. This is where things began to change. The goldsmiths noticed something. Not everyone came to claim their gold at the same time. Out of 100 people, maybe 1 or 2 would show up. The rest of the gold just sat there in the vault, and that led to a simple thought. If this gold is just sitting here, why not put some of it to use? So goldsmiths began issuing more receipts than the gold they actually held. They lent out claims on gold that didn't really exist. They charged interest. No one noticed because not everyone demanded their gold at the same time. This small trick eventually became the foundation of modern banking. Banks emerged. Then governments adopted the system. In 1694, the Bank of England was founded, but its purpose wasn't to serve the public. It was to finance war debts. The state borrowed money it didn't actually have. The interest on that debt was paid through taxes collected from ordinary people. If this sounds familiar, it's not a coincidence, because what's happening today is fundamentally the same. America followed a similar path. Banks issued banknotes redeemable for gold, then began creating more money than the gold they had in their vaults. Sometimes people realized what was happening. They rushed to banks. They demanded their money, and they discovered it wasn't really there. Banks collapsed. Crises followed. But the system wasn't abandoned. On the contrary, it was strengthened. Central banks were created. The message was clear. Whether the money is actually there doesn't matter. What matters is that people believe it is. Today the system is more complex, but its core is the same. When you deposit $100 into a bank, that entire amount does not sit in a vault. The bank keeps a small portion and lends out the rest. That loan enters someone else's account, gets deposited again, becomes another loan, and the same money is multiplied over and over. Eventually, that $100 turns into hundreds of dollars moving through the economy. But in reality, the amount of physical money that exists is very small. The rest is debt. And today, things have gone even further. In the United States, the reserve requirement banks must hold against deposits is 0. Banks now create loans first and check compliance afterward. When you take out a mortgage, the bank doesn't hand you cash from a vault. It types new money into your account. That money exists because you promised to pay it back. That's why most of the money circulating today isn't money printed by central banks. It's money created by banks and money born from debt. This structure leads to 3 major consequences. First, inflation. As money multiplies, each unit loses value. This isn't just about supply and demand. It's a natural outcome of the system. Second, perpetual debt. Because money is created through borrowing, there is always more debt than money available to repay it. Someone must always borrow more, delay repayment, or default. Third, power imbalance. Those who benefit most from this system are asset holders. Inflation drives asset prices higher. People who live on wages are forced to run faster just to stay in the same place. When the system shakes, this becomes clearer. In 1929, in 2008. When crisis hits, governments and central banks step in to save the system, because without it, the modern economy cannot function. And here's the hard part. This system cannot tolerate everyone being debt-free. If everyone paid off their debts, money would disappear. The economy would stop. The system depends on our borrowing and on our belief in those numbers on the screen. This isn't meant to scare you, it's a call for awareness. Money is not wealth. Real wealth is knowledge, skills, production, land, and independence. Debt is not neutral. Inflation is not an accident. Knowing this doesn't mean disaster is inevitable, but it does remind us that we don't have to live with our eyes closed. History shows us this. This story isn't new. Only the scale has changed. If you understand the system, you can position yourself more consciously within it. If you ignore it, you continue playing a game where the rules are written by others. History holds the answers, and if you want to learn where to look for them, subscribe.